I'm so grateful that you didn't describe me as the king of cannabis, which is one of my other names, and that's a little out of date because, more recently I'm also known as the Sultan of psilocybin. Say that 5 times quickly. I apologize for the formality. I will have my jacket buttoned up. I spilled Philly cheesesteak juice all over my shirt. And so for the benefit of the viewers at home, I will leave my jacket buttoned up. And in talking to the tech folks at the back as I was being mic'd up, they reminded me that only 3 weeks ago I was here, actually down on the 17th floor at the other Advantage venue, participating in finance industry celebrity family feud, which is way harder than it looks in real time. Let me tell you, I failed miserably. Our team won, no thanks to me. I got all the questions wrong. I got the buzzer. Oh, it was terrible. In any event, hopefully today will be a better opportunity to talk a little bit about the Canadian Securities Exchange. And again, thank you to those of you from Urbana Corporation, Caldwell Finance, have been wonderful partners, and I'll get into a little bit about that over the course of the presentation this afternoon. And I guess I'll start by saying, and this is totally off script, first off, I don't have a disclaimer, which is kind of funny since I'm actually a securities lawyer, kind of. But yeah, none of that, and run an exchange where we worry about stuff like that, but none of that. Secondly, I'm going to let you in on a dirty secret in the Canadian financial services world. We are losing companies at an enormous rate. So you saw the op-ed in the Globe last week, a couple of finance professors from the University of Calgary talking about this very issue. If it wasn't for Raj Lala's ETFs and his competitors and some of the other financial products which have been listed on the Toronto Stock Exchange over the years, we'd have suffered a collapse in the number of listed companies in Canada by 50%, basically. Right now, half of the issuers on the Toronto Stock Exchange are ETFs or other financial products. Only half of the issues are active companies that are employing people, investing in innovation, providing good jobs, and contributing to Canadian corporate development. So that explains, in a nutshell, why the Canadian Securities Exchange came to be about 20 years ago. We wanted to preserve that path to the public equity markets, that access to growth capital for entrepreneurs in Canada, by taking a fresh approach to how exchanges regulated those issuer companies with the view to be more efficient, more customer service oriented, and in particular, more cost effective, taking less time. Saying no right away if the answer is no. Occasionally saying yes when the answer is yes. But speeding that time to market, reducing that cost, that uncertainty, that risk that entrepreneurs face when they try to take their companies public. And so, as you'll see over the course of the presentation, and it's been a couple of weeks since I've seen it, so it'll be as much a mystery to you as me as when we get to the actual presentation. But the feedback from the industry, particularly since Mr. Caldwell and the Urbana team led a recapitalization of our company back in late 2012, has been enormous. So we now have, I just checked, 817 issuers and about 765 active companies. We don't have any ETFs. We don't have any financial products. These are all active companies that have raised money from the public, are investing in innovation across every sector of the Canadian economy. And we are so proud that with the support of the Urbana shareholders, that we've been able to help them on that journey. So that's basically the presentation, actually. I cut to the chase, as I often do. But basically, again, and I think Brendan, when the first time we used this slide, noticed that somebody photoshopped the BMO sign off of our head office just across the street. But we are, in fact, recognized as a stock exchange by the Ontario Securities Commission and the British Columbia Securities Commission. So we have 2 regulators to deal with, and yes, that means it's about 4 times as many problems as we have to deal with using the normal rule of thumb. And as I said, the reason that we exist is to create that better, more efficient path to public capital in Canada. And it's not always the right answer. I mean, for me to stand up here having accepted private equity, having worked at a number of companies that are raising private equity is often the right answer for companies at particular stages of their growth. But when public capital is the correct answer for the company, we want to be there for them in order to provide that opportunity. And again, it's not just the entrepreneurs that get to benefit. Tom talked in his opening remarks about the opportunity to permit regular investors to participate in these companies during their highest periods of growth by buying Urbana and having that portfolio of private companies. Because you're right, people can't invest directly in the Canadian Securities Exchange, Blue Oceans, Tetra Trust, and so on at this stage of their growth, and this is where they're going to be growing their fastest. Right, Matt? Right, Didier? This is where the wealth is going to be created. So we want to provide that opportunity. We're going to democratize the markets so that everybody can participate, not just the few folks that have the financial wherewithal to invest in private equity opportunities. We're weaponizing investment. And again, I just have to say it out loud. We, by most measures, we're the fastest growing equities market in the world. There, I said it. Not very Canadian of me, but by virtually every measure. I can remember years ago I was on the meeting with some folks from the Deutsche Börse in Frankfurt. That's all the German you're going to get out of me today. They were asking me, well, how many companies went public on the Canadian Securities Exchange last year? And I said, it was kind of a weak year, about 87 or so. They'd had 5. Now, of course, any one of theirs had more enterprise value than all of ours combined, but he liked the number, 87. So what have we seen this year in the markets? Well, of course, the weather, you'd assume, was a reflection of how business is going at the Canadian Securities Exchange so far this year. In fact, aside from the fact that trading is not very good, not very robust, because we are primarily servicing a retail trading market. About 93% of the shares in Canadian Securities Exchange listed companies are held in retail accounts in Canada and in the United States. We obviously have good penetration in the US because of our early support for the US cannabis industry. But what we have seen is a continuation of strong new listings in the mining industry in particular. And so as you can see on a year-to-date basis, and this I think was end of September, we've already listed 90 companies. This is going to be our second best year ever for listings. Last year obviously was our best year. And we listed 13 companies in September alone, which is a really good month, even when things are robust. The difference being is that the majority of them are relatively early stage, fairly small, $15 to $20 million enterprise value, mining exploration concerns. Mike Bluestein here knows that because he listed 2 of them. But here's the thing. These companies, by and large, are not just looking for precious metals in a greenfields project in West Africa or some other jurisdiction that's long from Canadian shores. This is all about finding the battery metals, the materials that we'll need to electrify the economy with a shortened supply chain in politically reliable jurisdictions. Now again, I may have just referred to Canada as a politically reliable mining jurisdiction, and I would get an argument, I think, from some of the mining industry on that. Come on, work with me. I know it's after lunch, but I'm trying to... But the difference is, a lot of these projects were drilled 40, 50, 60 years ago, and the price of the underlying commodities has been depressed by particularly activities of the Chinese and the Russians. They're kind of off the field for a while, maybe for a long time, and the prices of the commodities are now economic to support the development of these mines. So there's a very high potential for every one of these, or a number of these projects, to become producing mines in a 3 to 5 year time horizon. So it's a completely different sport than the 1 out of 130 odd mining projects that generate a producing gold mine. for example. So different story altogether. But we continue to see technology companies, life sciences companies, and yes, even the odd cannabis company still shows up on our shores. And we know that there's a much bigger addressable market, particularly in the United States, number of companies which are successfully operating at single state levels and multi-state levels that have held off their plans to go public because of the asset valuations at this point. But they are just waiting. And again, our expectation is that at some point, and I'll talk a little bit about a potential catalyst event, we'll see another cohort of cannabis issuers join the Canadian Securities Exchange in the not too distant future. And if that's a forward-looking statement, then I'm guilty as charged. Here's another fun indication of how much impact we're having on the Canadian securities industry right now. Now, to have 37 IPOs to date in Canada this year so far is not a particularly impressive number, but we've done 21 of them. We're getting more than half. And on a head-to-head basis, we are winning all the battles with our key competitors who are the Toronto Venture Exchange, the TSXV, and our friends over at what used to be called NEO and is rapidly becoming the CBOE Canada stock market. Our price point is right, and we've developed a solid reputation amongst the legal community, the accounting community, and the corporate finance community working at the securities dealers for excellent customer service, quick turnaround, and a price point that works in particular for the mining exploration issuer. So as a result, as I say, we are winning the lion's share of the battles and winning most of the business coming to market at this point. Now, having all of Canada is great, but we need to keep refilling that pipeline. And so with the end of COVID, our teams are increasingly traveling internationally. I've spent a lot of time in the US over the last 4 months or so. We'll be back in Israel in a couple of weeks, a tremendous source of new companies and innovation, particularly in cannabis, life sciences, and agricultural technology, which is a really exciting, interesting field. I'll sum it up this way: grow more with less water, less fertilizer, less pesticide. And the world is really going to need farmers in Canada, the United States, Australia, Argentina, Ukraine to up their production capabilities in the coming years to prevent food insecurity across the world. It's a sector I'm really excited about. We're also going to be in Australia. They're in their cycle of PDAC-type mining shows. I'm not going this time. It's a really, really, really long flight. And as I tell people that do in fact elect to go public in Australia, I said, it's great, you're public in Australia, that's the good news. The bad news is you're public in Australia. You are a long, long, long way from anybody, your investors and so on. So we're expect to see, and we have seen over the course of the year, strong support from the Australian mining community to dually list between Australia and Canada, or in fact just simply moving their listings from the ASX to the CSE. We're not telling the ASX that we don't want them to be mean to us when we're down there, but that's been a very successful and we believe will be a growing pipeline of new companies. What's next for cannabis? People ask me about this all the time because, of course, as I mentioned at the outset, I am the king of cannabis after all. Where that came from, as many of you know, I'm fairly self-deprecating when it comes to these things, and so standing up and making it. I was on TV one day, and they had a crawler going across the base as I was being interviewed on BNN, and the crawler, which of course I couldn't see when I was in the studio, said, "Richard is the king of cannabis listings." But of course the TV wasn't wide enough to get king of cannabis listings, and so I got more screenshots from friends of mine. My phone exploded when I turned back on, "Richard is the king of cannabis." Thank you very much. That will put me in good stead the next time I attempt to enter the United States of America. But so far, so good. This new facial recognition thing is fantastic at the airport, right? You can walk in and they know who you are. You don't have to fill anything out. And they say, "Mr. Carleton, have a nice..." It's great. Anyway, out of our 817 companies, 162 are cannabis. So it's obviously an important sector for us. And it does actually represent, with the US multi-state operators, a significant percentage of our market capitalization. As you can see, 22 billion when we did this. It's actually more like probably 25 or 27 billion today because the sector's having a good week. The really good number here that we're proud of is that the US industry raised $16 billion on the Canadian Securities Exchange from 2016 to today. And as I was quoted in Bloomberg and the Wall Street Journal, 16 billion even in Canadian dollars ain't chump change. They like that. But here's what's, I think, going to happen in the space. Everybody saw Mr. Biden's announcement a couple weeks ago that they were going to, and I think this was a politically motivated attempt to have a wedge issue with the Republicans with the midterms coming up, that they were going to allow people convicted of simple possession offenses in the District of Columbia, because that's the only place the U.S. federal government has criminal jurisdiction, to apply for pardons, and that he'd also told two of his cabinet secretaries to review the status of cannabis under the Controlled Substances Act, because everybody knows it's a Schedule I drug. It's with heroin, LSD, and a bunch of other things that'll kill you. When we know that it shouldn't be anywhere close to Schedule I, maybe Schedule II or Schedule III, or in fact not scheduled at all. Now, fortunately, Mr. Biden made that announcement during market hours. Our index, which is heavily influenced by cannabis, was up 35% in 2 hours of trading, on heavy trading. It was awesome. The sector gave up about half of that over the next couple of days, but still on heavy trading. It's all good. As we say, it doesn't matter if it goes up or down. We just like the trading. Like that's one of the ways we get paid. But we also saw yesterday a nice bump in the sector, because Canopy is trying to figure out how to more directly participate in the U.S. cannabis industry. And so they've taken a bunch of their assets, put it into a U.S. holdco, exercised some warrants to take over one of our existing companies, and shares of another company that they'd invested that's listed on us. Somehow they've convinced the TMX and the NASDAQ that this is all okay. I'm not convinced that ultimately it's going to work. I suspect we're going to get a new issue or two out of this transaction. I can only hope. But that gave the sector about a 5 to 7% pop yesterday. So the midterm elections, I'm going to follow my mentor, Mr. Caldwell's approach, and just lay it out there. The Democrats are going to get smoked in historic fashion. And everybody assumes that that means bad news or trouble ahead for the cannabis industry. But I do have the privilege of spending a bit of time in Washington. I'm a member of a couple of lobby group associations in the U.S. The likelihood is, in fact, the Republicans, whether it's during the lame duck session or whether it's when the new Congress is sworn in early next year, are likely to pass what's called safe banking, which will enable the cannabis industry in the United States for the first time to have bank accounts, insurance, and most important of all, to be able to get on the credit card payment rails. Because right now, if you go into a dispensary in the United States, they can advertise. You can see billboards all over the legal states. They've got delivery services, they've got websites, they've got brand development, all of the things that you would expect from a consumer packaged goods industry, but you have to pay cash. And that's a problem, because there are a lot of financial institutions who will in fact not do business with them in any way, shape, or form. It's one of the reasons why I was agreed to go on the board of Safe Harbor Financial, because they are banking these companies in the states where it is legal to do so, and they have enormous opportunities whether SAFE goes through or not. But it means that employees are having to take literally green garbage bags full of cash down to the local credit union where they are banking, and a lot of those people are getting robbed, kidnapped, extorted, or otherwise subject to crime. And it's become a real public safety issue, and the Republicans are actually on side with getting rid of that dependence on cash money. I'll also say that the Fed is also not excited with that much cash being around a particular industry, because it tends to find it tends not to come into the legitimate business world as well. In any event, don't assume, in fact, the midterms may present, in fact, an historic buying opportunity in the space. There's another forward-looking statement, thank you. So This week we launched our second trading book. I'm not going to get into, with 9 minutes and 14 seconds, a dissertation on Canadian micro market structure as to why having 2 books is better than 1. Just take me on faith that it is. But basically what it is a response to is zero commission trading in Canada from the retail brokers, some of the disruptors, that one that starts with Q and rhymes with rest trade. Wealthsimple and some of the other disruptor brokers, they need to have a particular business model that requires 2 books from the exchanges in order to get paid or to be able to monetize their client flow and offer zero commissions. My expectation is that most of the brokers servicing a retail discount community will be zero commission at some point in the next couple of years. So we had to be positioned to do that. Market data, again, people all over the world are more and more interested in trading activity on the Canadian Securities Exchange. So we are successfully selling more of our data through all of the channels, Refinitiv, Bloomberg, others that service retail clients as well. And that has been a solid sort of 6 to 10% annual growth for the company. And a few major initiatives. I should step back here because I was going to, before I talked about some of the business lines, set the stage. So people always ask me, how do exchanges make money? 3 ways. We take a small slice off of every trading or transaction that takes place on the exchange. We also sell the market data, which I just talked about, through a network of very sophisticated information vendors around the world. And also the listed companies pay us fees when they join the exchange, and then a semi-annual or annual fee to remain listed on the exchange. The problem is, or the challenge as business managers, there's a lot of leverage in that model, in that we don't have to invest a lot more on our technology because we can handle the trading volumes that happen. Our regulatory staff is big enough to handle temporary surges in applications. And market data is really, once the gateways are built and the feeds are provided to the vendors, we can service potentially every consumer on earth without making a significantly additional expenditure. But a lot of our revenues are subject to the vicissitudes of the market. So I mentioned trading is down 50% from where it was last year. Well, it runs to our bottom line. So as we mature as an organization, what we're looking to do is attract more recurring revenues, more subscription revenues. And that explains why I'll say it out loud, our peers, such as the London Stock Exchange Group, New York Stock Exchange, and NASDAQ, do tend to invest a lot of money in the provision of technology services or market data products or analytics or other applications that are designed to generate income no matter what the state of the markets at any given time. So we're at a point in our existence where we're beginning to look at those opportunities. We're also part of a network through Urbana of like-minded companies. Matt and I spent part of last evening re-architecting our, Matt was doing most of the re-architecting. I was nodding politely and smiling at him. Our respective technology environments, which is a very powerful kind of association that we have by virtue of our membership in the Urbana family. I can see I've got 5 minutes and 28 seconds. Yeah, no. They can talk to me later. You'll hear from Didier later on, providing the first recognized custodian for digital assets. Well, we think the next big growth space is going to be in tokenized or digital securities. So in order to facilitate that, we need a tetra in place to have a secure place for investment dealers and institutions to custody their digital assets. So this is all part of the community that we can help solve each other's problems. And when we get one of our initiatives here, I talk about our senior tier, I'll be talking to Rajlala about having a few CSEs on that instead of TSX and one NEO. And we've had those preliminary conversations, but we're really close to getting that, Brendan, we are really close to getting that initiative through. No, he's not. That's simply not true. We will be engaging in some rebranding over the course of the year to reflect our maturity as an organization. Our esteemed former chairman, who wrote the old logo in the Air Canada Lounge in Calgary in February of 2013, has a tremendous pride of authorship. I can guarantee that what you will see is evolutionary as opposed to revolutionary. But in any event, I will allow a few questions at this point. I will say, in closing, check us out on social media. We've been doing fantastic things over the last couple of years through COVID. Our YouTube channel is big enough that Google pays us. Google pays us for the content that we generate. It's about $600 a year, but they pay us for the content that we generate. We do a lot of podcasts. We do everything that we can to really give our issuers a platform to tell their story, to connect with potential investors and people that are interested in learning more about some of the industries that we're working with. So yes, I apologize I didn't think I'd come close to filling half an hour, but we've got a couple minutes for questions, so I'd be happy to take any of them.
This second book that you're doing, that's for the discount brokerage firms who shall remain nameless, but that's so those discount brokerage firms can make money off trading and get paid for the trading they do for their clients. So would I be off base in saying that, much like Karen described, if you're on Apple, you're the product, if you're a client of a discount brokerage firm they're not paying much, if any, fees, you're actually the product off of which they make money? Would that be an unfair statement, Richard?
I will tell you something even more scandalous, which Matt knows well. In the United States, the brokerage firm actually shares the benefit of the monetization of that order with the client through something called price improvement. So if you trade in the United States through most brokers, you'll see that you get an execution price that's a weird, like, sub-decimal of, maybe 0.1 or 0.2 or something like that. Part of that is a price improvement payment that your dealer is sharing with you. In Canada, the dealer keeps it all. They don't share with the clients. I guess there's another dirty secret that we've exposed. So yes, that is in fact what's going on.
Richard, at the Urbana AGM, you had talked about clearing, and my understanding was you were going to be testing it out with some of the major brokers. So just wondering if you could give us an update on that front.
Yes, that is gone. The testing is almost complete. We have a few minor nits to clean up. What I'm looking at now is to get the clearing piece approved by our friends at the regulators is going to be a very big, costly struggle. There's a whole bunch of other stuff that we're providing, which is actually where the value chain, or the most part of the value resides. And we're looking to launch that in the short term. So this would be the management of corporate actions, which say dividend payments, management of the cap table for the issuer. So they'll actually know how many shares outstanding they have at any given time, which for those of you who run public companies that's a hard question. And best of all, with the cooperation of the dealer community, they'll actually know who their beneficial holders are for the first time. So, and I have 3, I would say, very solid prospects to list the first digital security in some point in the not too distant future. So really it's dependent on them getting those instruments cleared by prospectus through one of the provincial securities commissions. We'll get them listed, and then we'll be providing that back office component through the service that we've delivered while working on the recognition of the clearing and settlement component.
So what would the timeline look like on the clearing?
It depends on the clients getting the product cleared by the regulators. But what we're seeing is pretty straightforward stuff that I would think we're some point spring of 23.